Hello, everyone, and Happy New Year. On behalf of every member of the Heritage team, I want to welcome you to this year's first installment of our Inside the Markets series. I'm joined today by two of my colleagues, Carrie Baronian, our Director of Research, and Steve Henderson, our Director of Private Investments and Foundation Strategies. Our hope today is that by inviting you into our conversation, we can share some of our insights as it relates to our outlook on the economy and markets, as well as how we currently have client portfolios positioned.
Yeah, but Jay, before we get into all that, maybe we should just sort of wrap up 2022. There's lots of challenges in 2022. The markets were quite volatile, lots of things to think about, worry about. The world's very different today than it was a year ago. So, but I think Heritage had a pretty good year all in. There's a lot of good stuff that happened here. So why don't we just wrap up last year?
Yeah, it was a challenging year. It's hard to walk away from that. It was a challenging year for all investors, and maybe to put some numbers to what we mean by challenging. Large cap U.S. stocks, for example, were down 18% for the year. Small cap and international stocks were down closer to 20%. And then, if you think just about the large cap technology sector, which has really led the markets over the course of the last decade, those businesses were down on average 30 to 35%. And then there's the more speculative areas of the market, which our clients have not participated in, which were down more like 60 or 70% for the year, on top of meaningful declines in the third and fourth quarter of 2021. But what was really unique about last year was not that equity markets corrected and then we entered into a bear market, but really it was the dynamics within the fixed income markets, where given the extraordinarily low level of rates that we started the year at, we had an environment where fixed income markets were down 13% for the year. Bonds were down 13% for the year. Now, when you think about a balanced portfolio and you think about the role that bonds are expected to play, it's twofold. One, it's to generate income. And secondly, right, it is to provide that ballast to the portfolio in more challenging environments for equity markets. You have to go back over a century to find the last period where we had a year where both fixed income returns and equity returns were down double digits. And so it truly was a challenging year for investors. Now, I feel really good. I'm really proud of the work that our team did over the course of really the last couple of years to position client portfolios in a way that allowed our clients to hold up meaningfully better than the overall broader markets did over the course of 2022. And I think importantly, that's really foundational to our investment philosophy. It is to focus on quality and focus on risk management in a way that it allows our portfolios to participate in markets that are rising, but equally importantly, to preserve capital in more challenging markets. We all can do the math exercise that says if you go down 20% in a portfolio, you have to go back up 25% just to get back to even. And so when we are having our meetings and we are focusing and thinking and making decisions in portfolios, we are always thinking about our clients' portfolios in the context of how do we both participate in stronger markets, but every bit as importantly, it's critical that we protect capital in more challenging markets. But Steve, I think it would be interesting. That's a public market overview. Yeah. Maybe to make some comments on where we are in the private, have been in the private markets.
Yeah, so private markets in 2022 was a mixed bag, actually. Some things turned out pretty well in 2022, in particular credit. You just heard Jay talk about fixed income being down 13%. A lot of private credit strategies, direct lending strategies, and things of that nature, they were up 8 to 10%. It was a good year for them. Conversely, valuations on the equity side, in particular, things that had run up quite a bit, late stage venture is the obvious example. Those valuations are getting readjusted. So, and there's some, a little bit of pain there, and there's probably more pain coming. So, in total, though, the whole world of privates really was additive and provided ballast to long-term pools of capital. I think when you start seeing endowment returns who make heavy use of alternatives, those returns are going to look really good relative to the public markets. And that's one of the benefits of investing in these markets. So, up and down year across the whole private landscape. But there was some good news in there too.
Yeah. And I would just add on to that, we remind ourselves all the time, unfortunately, we can't control the direction of the economy and financial markets, but there are a lot of other things we can control to add value for clients. And we focus on those things constantly. especially during periods of increased volatility and when the market is simply going down. Would say, aside from the top level asset allocation decisions and security selection, would want to highlight some of the core components of our portfolio management process, as well as our proactive tax and financial planning as really important contributors to our outperformance and why clients are in a stronger position. So just to give a couple of examples from a portfolio management perspective, things like implementing a disciplined threshold-based rebalancing approach and aggressively tax loss harvesting. And then as it relates to tax and financial planning, converting IRA assets to Roth where appropriate, and being thoughtful about strategies for charitable giving, for instance, whether to gift highly appreciated stock from a taxable account or make a qualified charitable distribution. I'd say we really believe strongly that the intersection of investment management, tax, and financial planning is where we do our best work. Wouldn't go so far to say that we like volatility, but recognize it does create opportunity for us to add value for our clients and show what makes us different.
So now we're in a new year, 2023. Lots of challenges are still challenges. So Jay, why don't we start talking about 2023 and we'll go from there.
Sure. Yeah. This is the time of year when we all make prognostications, right? And we're certainly no different. Although, what we really attempt to do is make some judgments around where we are in a market cycle, where we are in an economic cycle. And I think in order to do that, it's important to, contrast where we are today, for instance, with where we were a year ago. A year ago, we were in an environment where, the economy was strong and inflation was accelerating, yet interest rates remained at historically low levels, right? And, you had the Fed, which was signaling that they were going to begin to raise rates and tighten monetary policy, but they hadn't actually begun to raise rates yet. And in that environment, you had valuations which were very extended. You had speculation that was pervasive, really across asset classes, not just in financial markets. You could point to housing and real estate as another example. And our view at the time was that if you were willing to stay disciplined, and focus on valuation and focus on fundamentals, you were able and you were willing to lean against the momentum of the market. You had the ability to position client portfolios in a way to really mitigate potential risk in portfolios. Now, contrast that with where we are today, and I think that today, as we look forward, probably the best description that I've seen as it relates to the environment today is encapsulated in the title of a research report that our partner Michael Goldstein at Empirical Research put out, which was titled "Fog Bound." Right? I mean, we are in a more challenging environment where the range of outcomes is very, very broad, but we can focus on what we do know. Right, and what we do know is that, as an example, when we look at some of the risk and challenges in the market, geopolitical risk remain acute. Russia and Ukraine remain at war. Our issues with China continue to be a challenge, and then domestically we have challenges as well. But I think what's interesting is that the Fed, Steve, you used the word consistent. The Fed has been very transparent and consistent in their desire to raise rates, to tighten monetary policy, to lower inflationary pressures. And what's interesting is that is occurring in an environment where we're beginning to see at least the leading indicators of economic activity begin to slow. Whether you're looking at industrial surveys, housing, if you look at money supply. Money supply is now negative. It's very challenging to envision an environment of economic activity accelerating when money supply is falling. And inflation is beginning to decelerate. We just got an inflation number yesterday, right, which was 6.5%. Still a high number, but down meaningfully from where we were 3 or 4 months ago. But at the same time, we see wage growth that remains persistently high. Mm-hmm. The last piece that we do does give us some pause is that we are entering into a slower economic environment where the fiscal deficit is already at 5%. And so when you think about traditional reactions to slowing economic activity, where either monetary policy or fiscal policy provides stimulus, it's a more challenging environment given the Fed's mandate, the Fed's consistency around their approach, and given that we're already at very large fiscal deficits to see where meaningful stimulus might come from as we move forward. Now, on the other side of that, valuations have certainly come back towards more reasonable levels over the course of the last 12 months. And so certainly when we think about where the position, the potential for long-term returns, we are at valuation levels that suggest that long-term return expectations should be improving. But in this environment, it's really about fundamentals. Fundamentals matter in this environment, and being focused on quality and continuing to be focused on risk management remains really central to how we have client portfolios positioned.
Yeah, and I'd like to add on to that. You guys know in our research meetings recently, we spent a lot of time talking about expectations for corporate earnings, which are for earnings to basically plateau at really high levels. And when we look at those headline numbers, I'll speak for myself personally, when I look at those numbers, I think of them as really the average of two very different base cases. On the one hand, appears to be a group of investors who are concerned and believe that we are either currently in or about to enter a meaningful recession, which would have significant negative implications for corporate earnings growth. And then on the other hand, there appears to be another group of investors that have a more positive outlook, whether you want to call it soft landing, potential Fed pivot, but the bottom line being expectations for continued corporate earnings growth. We would say, thinking about that, it seems like it's hard to put a lot of faith in those headline numbers. Not sure many people believe the headline numbers are going to be reality. So whichever case it may turn out to be, we're certainly in the camp of the former, one of concern and moving forward with caution. Seems like the market's going to need to undergo a period of repricing. But what would you say about the private markets?
Private markets for 23, look, challenges still remain. I think, the venture world, it's going to come down to, if you're a venture-backed company, it's going to be a function of how much cash do you have on your balance sheet. Mm-hmm. And if you can survive 2023 and probably the first part of 24 without having to raise capital, it might well turn out okay for you. If you do need to raise capital in 2023, you're going to do it at a lower valuation. Could be a meaningfully lower valuation, and that's going to hurt. So that's the late stage venture world. And why is that? That's because it's run up so far. And so it has the farthest to fall. If you're a little manufacturing company and you have $10 million of EBITDA, your valuation hasn't changed all that much. And so it's changed a little bit, and that's actually providing some interesting things for us to think about. I would say, generally speaking, if you can buy good assets at 10 or 20% discounts to what they were trading at a year ago, that's probably a pretty good entry point. And then similarly, on the credit side, it remains a lender's market. You can get high quality loan positions in place where you might be senior in the capital structure, you might have collateral behind you, you've got strong covenants that you can force the companies to adhere to. It's your market. It's not a borrower's market, it's a lender's market. And so the credit opportunities are pretty attractive. I think some of the lower middle market buyout opportunities are attractive. I think there's really a lot of attractive things to look at. One area of concern is sort of late stage venture, because that's got the farthest to fall, and it's going to fall further. So we're pretty interested in looking at opportunities in 2023. Okay.
Well, Carrie, maybe we can pivot from how we're looking at from 10,000 feet and talk a little bit about our client portfolio positions.
Sure, and happy to start with the equity allocation. Would say from an equity standpoint, continue to own our concentrated leaders portfolio as the core of our exposure. Concentrated leaders continues to consist of 23 U.S. large cap companies. Portfolio remains diversified across sectors. If we look back over the past quarter, weren't really any notable changes to the composition of the portfolio. We continue to emphasize quality at reasonable valuations and receive the question sometimes from clients, well, what do we mean by quality? What we mean is businesses with durable competitive advantages, relatively stable end markets, high free cash flow margins, and strong balance sheets. Because of these characteristics, we believe these businesses are or should perform defensively if the economy continues to slow. But with that being said, also believe these businesses are capable of delivering solid growth over the long run. And would say that's really where our valuation overlay comes in. We want to own businesses with attractive growth potential, but also want to be mindful that we're not overpaying for that growth potential. Or said differently, we want to purchase businesses at price points that imply a margin of safety. It's to us really the combination of the growth potential and reasonable valuations that should be driving acceptable returns over the long run. And then if we look overseas, continue to manage international equity allocations below long-term targets. A lot of the issues that we see in the US, we also see in international markets, but on a deeper or broader scale. While international stocks continue to trade at a sizable discount to their US peers, we still struggle to envision what would be the catalyst for those stocks to outperform on a sustained basis. And then one other area within equities, we continue to hold a position in natural resource equities, continue to believe they possess attractive growth, income, and diversification potential. Valuations still look compelling in both absolute and relative terms. As expected, these businesses have helped preserve capital during an inflationary period. With that being said, they are cyclical businesses, and so we certainly wouldn't anticipate that they would be immune if the economy continues to slow. But we do continue to believe that they are leveraged to very powerful long-term secular tailwinds. For example, industrial metals are very important inputs to electric vehicles. And then also from a high level perspective, still an overall favorable supply-demand imbalance supporting prices due to ongoing underinvestment in new supply.
Great. Yeah, maybe I'll touch on bonds in the fixed income position with the portfolio here quickly, which is when we think about the fixed income portfolio, and we think about the overall portfolio, we are maintaining the same basic characteristics. We are focused on quality, we're focused on risk management, and so when we look at our portfolio, we are focused on quality. We don't believe that when we look at credit spreads, that you're current in an environment where economic activity is weakening, which potentially impacts the cash flows that are available to service that debt. We don't believe that you're being paid to take credit risk, and so we're heavily focused on a high quality portfolio with an emphasis on treasuries and investment grade municipal bonds. We're shorter duration in this portfolio as well. We're very short based on a view that over time interest rates are likely headed higher. And at the same time, when we look at the inversion of the yield curve, where we're finding value in the fixed income markets is at the shorter end of the yield curve, where we can earn 4.8% on a 2-year treasury bill, as an example. And then finally, we have introduced treasury inflation protected securities into the portfolio as a means to reflect a view that if inflation remains higher on a more persistent basis than current expectations within the market, we're building an insurance policy within our fixed income portfolio to preserve purchasing power in our fixed income portfolio, as those bonds will ultimately reflect and be paid the level of inflation in the overall economy. And maybe one comment on gold, is I think everyone knows we've owned gold now for about 18 months. And that was based on a view that one, we believe that in an environment of greater uncertainty and more volatility, that gold represented a store of value in our portfolios, and then secondarily from an inflationary perspective, in a view where we believe that over the longer term we're likely in a higher inflationary environment, owning gold as a store of value is appropriate. Now, what's been interesting is that we've seen gold be relatively strong over the course of the last 12 months in an environment where real interest rates have been rising and where the dollar has been strong. Both of those dynamics would traditionally, you would have said, if you had told us that would be the environment we were in, we would have suggested gold probably would have come under pressure. But gold has remained relatively strong in that environment to some degree, because we've also seen meaningful central bank buying over the course of the last 12 months as central banks around the world begin to look to gold as a way to stabilize their balance sheets. Now, Steve, we're we're moving forward. We're excited to move forward with the Heritage Private Fund, and I think it'd be great maybe to give everybody a little bit of an update on where we are.
Yeah, sure. So, so yeah, we are excited. We really appreciate the interest that we've gotten in this fund, and we're thankful for the support. We're going to have our first closing in mid-January with somewhere around $130 million. And then we're going to get to work allocating the money, and we'll take all year, maybe into 24 to do it as well. And I get asked all the time about the types of GPs that we'll put in this portfolio. And you've heard this word quality several times in this call.
Right.
It's no different over here in the private world. We're looking for quality GPs to put in the fund. What does that mean? To me, that means an understandable strategy, a repeatable strategy, a demonstrated track record of success, not just IRR, but creating multiples of invested capital, and with some discipline, distributing the capital back to the investors. So an understandable strategy, repeatable strategy, successful strategy, and we'll have a diversified set of exposures. We'll probably have 10 to 15 different line items in the fund, and we're really excited. It's going to, I think 23 and really 24 are going to prove to be really good vintages for some of these things, and we're really excited about getting going.
Great. Well, Carrie, Steve, thank you for participating with me today. And on behalf of all the members of our team, we thank you for participating and joining us this afternoon. We would encourage you to reach out to any member of the Heritage team, certainly your wealth advisor, with any questions. Thank everybody so much for joining us. Have a great day.